Hey, what's going on, everyone? It's Griffin here, and I hope you're all having a great day as always. Now, 2020 was definitely the year of the growth stock if we've ever seen one. Most stocks that crashed down in March made unbelievable recoveries over the course of 2020 up until, well, pretty much now, most of which are still trucking along to new all-time highs. Some specific Canadian examples that we spoke about on the channel over the course of this past year include Go Easy up above 300% this year, Afria climbed above 200%, and then we had Lightspeed and Shopify, two great Canadian tech stocks, which reached all-time highs this year. I think you get the point here that we covered a lot of fantastic growth stocks this year on the channel, and it was sort of hard to lose money even. And it's for this exact reason actually that a lot of new investors in the stock market now have extremely high expectations for what can be accomplished in the market with your investments in a short period of time. And although this is great and we had a really great year in 2020, it's also really important that we reassess what's going on in the overall global market environment, reassess what you're doing with your own investments, and then realigning for the new year, especially as a new investor. So that's why a couple of my past videos have been focusing on sort of the foundation and basics of portfolio construction that I think is really important for all investors to really focus on this year. So with that said, in today's video, I wanted to share my thoughts on 3 growth stocks that all trade on the Toronto Stock Exchange that I believe will do well over the course of next year, and that at the very least you should add to your watch list. As always, if you're new to investing and still need to open up a brokerage account, make sure to check out the link down below to open up a Wealthsimple trade account, which actually right now they're having a promotion where if you open and fund the account with minimum $100, you will get $25 for free, which typically it is actually a $10 bonus. So they're offering $25 right now if you open up an account with the link down below. Also check out the stock market investing course if you're new to investing and need the tools necessary for navigating the stock market properly and creating your own portfolio. So with that said, let's get right into the first stock on today's list. All right, so the first company we'll be speaking about today is called Enghouse Systems, ticker ENGH on the TSX. This is an enterprise level software application company that operates through 2 main business segments, the first one being Interactive Management Group and the second one being the Asset Management Group. So the Interactive Management Group provides customers with interaction software systems like interactive voice responders, dialers, voice collaboration systems, agent performance optimization software, and other services to large clients like banks, telecom companies, insurance providers, etc. So this is a pretty well-rounded software application company that offers products to enterprise level clients. Now, their stock currently trades for right around $62 per share, which interestingly has been downtrending for roughly the past 6 months when it peaked at $80 per share. In my view, though, this isn't necessarily a bad thing if you're a newer investor to this stock looking for some upside in 2021, because this 23% dip since August has brought the stock to a more reasonable valuation, and the company's growth and financials still remain strong. The forward price to earnings for ENGH is 33.88, which for the Canadian tech industry is actually quite decent considering that Lightspeed doesn't even have a forward PE, Shopify is looking at a forward PE of 294, and then Constellation Software is right there with Enghouse in the 30 range. Now, obviously, a company like Lightspeed or Shopify can't really be compared to Enghouse Systems on a one-to-one basis, but at the end of the day, they still operate in the Canadian tech industry. ENGH also managed to beat earnings over the past 3 quarters with revenues in 2020 of $503.78 million and net earnings of just under $100 million, all of which showcases a nice growth trajectory for this company. Do keep in mind, though, that prior to the pandemic, organic year-over-year revenue growth was quite a bit slower, and the pandemic really pushed revenues up at a quicker pace for ENGH, but even at that, this company's core business model remains strong and should see continued growth moving further into 2021 and beyond as they continue to expand their company through acquisitions. In fact, Enghouse has recently just acquired Altitude Software, which is an omni-channel contact center solution provider with annual revenues of around $30 million, which will further boost ENGH's revenues over the course of this year. And finally, the company's balance sheet is also quite strong with a current ratio of 1.73 and a total ratio of 2.85, both of which instill confidence in this company. Now, with that said, I am currently not a shareholder of Enghouse Systems. However, I am looking further into the company and keeping a close eye on them for an optimal entry point. Truth be told, though, for a long-term hold of this stock, I think pretty much any price point right now will do well in a growth-oriented portfolio. Alright, moving on to the second growth stock that we're going to be speaking about in today's video, we have a telemedicine company that I've actually spoken about quite a bit on the channel over the past couple of quarters, which is Well Health Technologies, ticker WELL on the TSX. Now, I actually haven't made any updates on this stock for a couple of months, and honestly, with how the stock has been trending lately, I thought this would be a great opportunity to do a little update on Well Health and provide my thoughts on how I see this stock performing over 2021. As of late, I still hold all my shares of Well Health Technologies as well as TDoc and CloudMD for that matter, even though the overall momentum in the investor space has sort of tapered off for telemedicine. But the reason why I'm still holding on to Well Health shares, and I even purchased more during the consolidation period over the past couple of months, is because I really believe in telemedicine as a whole in the future. I really do, even though 2020 proved to be a tremendous run for telehealth and the dust has now settled down a bit after this consolidation. The fact remains that consumers want more convenience, and the medical industry is at the forefront of a major shift. At least that's how I see things, and I don't believe that this is simply a COVID play. In fact, Fortune Business even expects the global telehealth market to grow at an annualized rate of roughly 25% over the next decade, bringing it to the $560 billion range by 2027, and a company like Well Health is in a great position to continue capitalizing on this growth. By the way, if you need more business context about what Well Health does as a company, make sure to check out this video right here that I released a couple months back on the channel. That's going to go in detail about what Well Health does as a company and why I'm so bullish on telemedicine in the future. Recently though, the stock has once again gained some further investor interest, bringing it back to the $8 per share range, and this places their current price to sales ratio at just under 30x. This recent stock run up was mainly triggered by news about further business acquisitions of the companies Allied Health as well as Articare, both of which are going to provide Well Health with further revenue potential. In fact, considering these recent acquisitions along with 5 others that Well Health has accomplished over the past quarter, Well Health is looking at propelling their annualized revenue run rate to more than $94 million, and they're also expecting to be profitable on an adjusted EBITDA basis for the quarter. And if you're keeping track of the price to sales ratio as a valuation metric, well, this $94 million annualized run rate is going to give Well a price to sales ratio of around 12x, which is definitely favorable. So yeah, this is some pretty aggressive expansion and revenue growth for such a small company, and further proves that Well Health's strategy of expansion through acquisition is working well for them. All this to say that even though we did experience a consolidation for Well over the past couple of months, I still believe this company has a very bright future ahead with an increasing addressable market. The company's balance sheet is also quite solid with a current ratio of 4.35 and a total ratio of 4.47, even though a good portion of their non-current assets are comprised of goodwill. With that said though, they do have enough cash on hand to fully eliminate debt from their balance sheet if they wanted to. Finally, analysts are also bullish on Well Health with an average price target across 9 separate analysts of $10.01, which is still a very nice 26% upside potential for the company. As a shareholder of this company, seeing an expected revenue run rate of $94 million, which is significantly higher than any previous years for this company, this is definitely something that I'm happy to see, and I have no plans whatsoever on selling this stock anytime soon. And I also don't think it's too late to get in on Well Health, because I expect this company as well as this industry as a whole to excel over the coming decade. Alright, so finally the third and last company that I want to speak about for some growth in 2021 is actually a cannabis company that trades on both a Canadian as well as an American exchange. The company is Trulieve Cannabis, ticker TRUL.CN in Canada and TCNNF in the United States. Now this is actually a cannabis company that's been on my radar for several months now. I even featured it in one of my industry comparison videos for the cannabis sector a couple of months back, but I only really started gaining further interest and looking into it on a deeper level when I saw fellow YouTuber Daniel Pronk speak about this company. For those of you who may not be aware, both Daniel and I have been long-term shareholders of Aphria stock, and we actually even made a collab video when Aphria announced that they were going to be making a merger with Tilray. Since that video being released, Daniel actually announced that he was selling off his position of Aphria. I'm personally still holding on for other reasons, but all this to say that he's actually re-put Trulieve on my radar. So I did some further research into the company, and yeah, I definitely think this could be a great opportunity for some growth in the cannabis sector in 2021. Now, first of all, let's speak about Trulieve's revenue growth since 2018, when the company first started selling cannabis. So in 2018, their total revenues for the year were 102 million, jumping by 145% in 2019 to 252 million, and now over the trailing 12 months, we're seeing revenues of 367 million, which is an increase of 45% year over year. Now, this is the type of growth that's nice to see from any company, but especially a cannabis company that's looking to maintain its position as a top player in the space. What's also quite interesting about TRUL, as opposed to other companies that operate in the American cannabis industry, is that they have been quite profitable in their production operations, as we can see from their net income over the trailing 12 months and in 2019. And I also expect a company like this one to continue thriving over the coming years for a couple of main reasons. The first one being that the American cannabis market is by far the largest market in the entire world and is projected to continue growing extensively to reach roughly $30 billion in annual sales by 2025, and Trulieve is one of the main players that will continue to capitalize on this momentum. This is also in parallel to the fact that with Joe Biden expected to come into office by end of January, a Democratic office should further boost decriminalization nationwide, which is obviously beneficial for cannabis stocks and could even result in this industry blowing past the projected $30 billion by 2025. This is actually a concept that I also spoke about in my recent exchange trade fund video that I definitely think you should check out if you haven't already for 2021, where I featured a renewable energy exchange trade fund under the same thesis here that a Democratic leadership in America is most likely going to have a positive influence on the growth of this industry. I've personally been bullish on the green energy sector for well over a year now, and this could further propel growth in that industry alongside the cannabis industry, both of which I see very bright futures for. Now back to Trulieve for a second though, this company has really great financials. So their market cap right now is around $4 billion, but they have a forward price to earnings ratio of 28.11, which is significantly lower than their trailing PE. And they're also looking at a pretty healthy profit margin for a cannabis company in pure growth right now at around 16.37% and an operating margin of 45%. Now this company is also showing extremely quick revenue growth at 92.70% quarterly revenue growth year over year, and their balance sheet is also quite nice at a current ratio of 4.7 with $193 million in cash. Alright, so that pretty well wraps up today's video featuring 3 growth stocks that each trade on the Toronto Stock Exchange. I really hope you enjoyed the video. Make sure to drop a like and leave a comment down below on what your thoughts are for each one of these companies. Now also, last thing here, if you're still new to investing and you need to open up a brokerage account, Wealthsimple Trade right now is having a limited time offer where if you use the link down in the description and you open and fund an account with minimum $100, you will get $25 for free rather than the traditional $10. So make sure to check that out if you're still new to investing and need a brokerage account. And on that note, I'll see you in the next one.